It's strange, isn't it? Every headline says America's economy is still strong, jobs up, market stable, inflation cooling. But buried inside the data, there's something quietly alarming. U.S. trade growth has nearly flatlined. Imports are barely moving, exports are losing momentum. And that slowdown is rippling through factories, shipping yards, and paychecks without most people even noticing. According to the IMF's World Economic Outlook 2025, global trade growth will crawl at just 1.7%, one of the weakest performances since 2008. Tariffs, supply chain rewiring, and protectionist policies are redrawing the map of global commerce. So why does this matter to you? Because when trade slows, opportunity does too. Jobs shrink, prices rise, and innovation gets trapped behind borders. This is the story of how the world's most powerful economy is entering a quiet new era, one where trade no longer guarantees growth. At first glance, the American economy looks unshakable. GDP is still expanding. Consumer spending remains steady. Unemployment has barely budged. But beneath those confident headlines lies a subtle deceleration that is reshaping the very foundation of growth, the flow of trade. Trade is the bloodstream of modern economies. It carries the goods, materials, and technologies that keep factories alive and innovation moving. Yet according to the IMF and World Bank, that flow has thinned to a slow trickle. Global trade growth is expected to be just 1.7% in 2025, far below the long-term average of 4 to 5% before the pandemic.
In practical terms, that means fewer ships crossing the Pacific, smaller order books for exporters, and quieter ports across the United States. It didn't happen overnight. The slowdown began years ago, but its effects have deepened since 2023. Tariffs have crept higher across multiple regions. The US and China, once each other's biggest customers, now trade less in critical goods like semiconductors, machinery, and electric vehicle components. The share of global trade covered by new restrictions has more than doubled in 5 years. For a country that built its prosperity on open markets, that's a silent reversal. Imagine a factory in Ohio that once exported precision tools to Europe and imported aluminum from Canada. The higher the tariffs, the tighter its margins. Shipments take longer, suppliers demand higher prices, and contracts get delayed. The owner keeps the lights on, but just barely. Multiply that scenario by thousands of small and mid-sized manufacturers, and you begin to see how a one-digit slowdown in global trade growth translates into layoffs, reduced shifts, and thinning paychecks. The irony is that the US economy still feels strong. Job numbers hold, wages have risen in nominal terms, and government investments in infrastructure and clean energy have injected life into domestic production. But those gains mask a fragile truth. Much of this strength is internally fueled, not globally connected. The American economy has started to grow inward, relying more on federal stimulus, reshoring incentives, and local demand than on the open exchange of goods with the rest of the world.
That inward turn may sound patriotic, made in America, by America, brings supply chains home. But the math is unforgiving. Trade accounts for roughly 1/4 of the US economy when you combine imports and exports. When that engine stalls, entire sectors begin to drift. Industrial output has flattened since late 2024. Freight rates for trans-Pacific routes are down sharply. Container throughput in major ports like Los Angeles and Long Beach has declined by double digits compared to 2021 peaks. The quiet hum of trade that once powered middle-class stability is fading. Part of the reason is geopolitical fragmentation. As the IMF notes, the world is dividing into trading blocs, the US and its allies on one side, China and its partners on the other. Each side is prioritizing security over efficiency, reducing exposure to rivals even if it means higher costs. It's a form of economic self-defense, but like all defenses, it slows movement. Trade, by definition, depends on openness. Once nations start building walls of tariffs, sanctions, and export controls, the arteries clog, and that's exactly what's happening now. The US maintains tariffs on hundreds of billions of dollars of Chinese imports. Europe has imposed its own carbon border taxes. Developing nations are responding with subsidies to protect their industries. The result is a global slowdown in the exchange of goods, a slowdown that doesn't look catastrophic in numbers, but feels suffocating in reality. For workers, the impact appears in subtle ways. The dock worker whose overtime shifts disappeared, the logistics manager whose company froze hiring, the steel worker whose plant is running at 70% capacity. None of them are reading IMF reports, but all are living the consequences. The deeper issue is that trade is not just about products, it's about productivity. When companies trade more, they specialize more. They innovate, compete, and invest. When trade slows, the opposite happens. Innovation stagnates, productivity growth weakens, and wage gains flatten. That's the invisible chain reaction now moving through the American labor market. Yet there's a paradox. For policymakers, this slowdown looks manageable. The dollar remains strong, inflation is easing, and the US economy still outperforms most of its peers. But that comfort is deceptive. A strong dollar makes exports more expensive and imports cheaper, exactly the opposite of what a country needs when trade growth is near zero. You can already see the cracks forming in sectors once dependent on foreign demand. U.S. agricultural exports to China, once a major growth engine, are down significantly. Semiconductor and tech exports have been hit by new restrictions. Meanwhile, American consumers, cushioned by post-pandemic savings, are spending less on imported goods and more on services, further cooling trade volumes. This isn't the dramatic collapse of 2008, it's something quieter, a slow turning of the gears, an era where globalism no longer accelerates living standards, but merely sustains them. The IMF calls it the new normal of slow trade. Others describe it as deglobalization. Whatever the label, the outcome is clear. The global economy is entering a phase where trade no longer drives the cycle, it drags it. Still, the full picture is even more complicated.
Because even as trade growth freezes, the number of trade agreements and supply chain realignments is exploding. Countries aren't abandoning trade, they're redirecting it. Mexico has become America's top trading partner, overtaking China for the first time. Vietnam, Malaysia, and India are gaining from supply chain diversification. But that shift takes time, and it doesn't replace the scale once offered by China-US commerce. So while the numbers may not scream crisis, the pattern tells another story, one of quiet adjustment, invisible displacement, and long-term risk. Global Growth 2025 looks steady on paper, yet beneath it lies a network of weakened connections. And here's the real question. What happens to a world built on expansion when expansion itself slows to a crawl? That's where the next part of our story begins, how a trade slowdown becomes a job slowdown, and why it might already be happening in your town. When economists talk about trade, they often use big words: deficits, surpluses, supply chains, comparative advantage. But for most people, trade means something much simpler. A paycheck that depends on someone, somewhere, buying what you make. That's why when trade slows, the first to feel it aren't the politicians or central bankers, it's the workers. In the Midwest, auto parts factories that once shipped components to Canada and Mexico are quietly cutting shifts. In Texas, ports along the Gulf Coast are handling fewer containers than they did before the pandemic. Freight companies that expanded during the e-commerce boom are now parking trucks and trimming staff.
The U.S. Labor Department's 2025 employment report shows a subtle but steady decline in manufacturing and logistics hiring. It's not a collapse, but it's a sign of strain spreading across sectors that depend on movement. This is the invisible consequence of near-zero trade growth. When global demand weakens, U.S. exports shrink. When imports stall, domestic distributors and retailers feel the pinch. Every slowdown in global shipping or industrial trade eventually turns into a local labor story. Fewer jobs, shorter hours, smaller bonuses. Take the example of the American machinery industry. It's one of the country's most export-sensitive sectors, supplying construction equipment, farm tools, and industrial machines worldwide. Between 2021 and 2024, U.S. exports of machinery grew nearly 9% a year. In 2025, that growth rate has fallen close to 1%. That single-digit drop translates into billions of dollars of lost sales and thousands of jobs that never materialize. But this isn't just about exports. Imports play a hidden role too. Many U.S. industries rely on imported materials and intermediate goods to keep prices low and output competitive. When global trade slows, supply chains don't necessarily collapse, they just become less efficient. Companies face higher input costs, longer delays, and smaller profit margins. Some absorb those losses, others pass them on to consumers through higher prices. That's part of why inflation never fully disappeared in 2024-2025. Even as energy and housing costs eased, the underlying price of globally traded goods stayed stubbornly high. Tariffs on steel, aluminum, and microchips raised costs for manufacturers. Meanwhile, shifting production from China to closer partners like Mexico or Vietnam added transition costs. The result? An economy that looks stable on paper but feels more expensive and uncertain on the ground. The IMF describes this as geoeconomic fragmentation. It's a clinical phrase for something deeply human, the unraveling of interdependence. When the world trades less freely, each country must do more on its own. That can build resilience, but it also creates inefficiency. Think of it like a group project where everyone stops sharing notes. Each student can still finish their part, but the overall result suffers. For the US, that inefficiency carries both risks and opportunities. On one hand, domestic production is seeing a revival. Semiconductor fabs in Arizona, battery plants in Tennessee, and renewable energy projects across the Midwest. These are the visible symbols of economic independence. On the other hand, such reshoring doesn't replace the scale or speed of global trade. Building a factory takes years. Losing export demand can happen overnight. It's a delicate balance, security versus growth. A decade ago, global integration was the default setting of capitalism. Today, fragmentation is the new normal. The 2025 IMF report calls it the post-globalization era, where trade is no longer about efficiency, but about alignment. Aligning supply chains with allies, aligning policies with security goals, aligning production with political priorities. For everyday Americans, this shift has subtle effects. Wages in protected industries may rise for a time, but competition fades, innovation slows, and prices creep up. The cheap imported products that once filled shelves become costlier.
The middle-class comfort built on low prices and high availability begins to erode. Yet the most profound consequence might be psychological. For generations, Americans saw global trade as a source of opportunity, proof that hard work at home could connect to prosperity abroad. But as global growth weakens, that optimism dulls. A new kind of economic anxiety has taken hold, one where people sense that the world is moving, but not necessarily toward them. In towns once built around export-driven industries, from shipyards in Louisiana to packaging plants in Wisconsin, the slowdown feels personal. The sense of connection to the global economy is fading. Fewer international orders mean fewer reasons to expand. It's a quiet contraction that doesn't make headlines but shapes local realities. Still, it's not all decline. Trade is evolving, not vanishing. Services trade, digital platforms, cloud computing, consulting, entertainment continues to grow even as goods trade stagnates. American tech firms, universities, and media exports are still expanding globally, but that kind of trade employs fewer people. A streaming deal in Europe doesn't replace a shuttered factory in Michigan. The digital economy scales fast, but it leaves fewer footprints on the ground. That's the paradox of modern trade. It's becoming more intangible. The US is still a global leader in ideas, data, and innovation, but those advantages don't automatically translate into broad job growth. You can export a movie or an app without shipping anything. The revenue flows back to investors and executives, not necessarily to the warehouse worker or port operator. So when trade slows, the impact isn't just economic, it's social.
It deepens divides between the digital and physical worlds, between regions that thrive on global networks and those that are left behind. Coastal cities tied to finance and tech remain resilient, while manufacturing towns tied to global supply chains feel the chill. And that divide is widening. The slowdown in US trade growth to near zero isn't just a headline statistic, it's the beginning of a new distribution of winners and losers inside the economy. Policymakers call it adjustment. For workers, it feels like drift. But even drift can carry momentum. The world is adjusting to a slower rhythm, and that means the next decade won't be defined by growth alone, but by adaptation. The question is who adapts first, because as trade patterns realign, the US must decide what kind of economy it wants to be, self-sufficient but slower, or open but vulnerable. That's the strategic dilemma shaping the future of American jobs, industries, and influence. The answer, as always, lies in what comes next, how a slowdown turns into policy, how policy reshapes power, and how power decides whose prosperity still counts. If you zoom out far enough, what's happening to US trade isn't a collapse, it's a rewiring. The global system that powered decades of expansion is being quietly rebuilt. Instead of one giant marketplace, we now have clusters of trust. The US and its allies on one side, China and its partners on another, with a few neutral economies navigating between them. This shift isn't temporary, it's the new architecture of globalization, smaller, slower, but more strategic.
At the center of this transition stands the United States, trying to protect its dominance while adjusting to a world that no longer moves on its terms. The 2025 IMF Outlook explains this paradox clearly. The US remains one of the few advanced economies still growing above 2%, yet its trade volume has nearly flatlined. Growth now comes from internal spending, not global exchange. The American consumer, not the global market, is carrying the load. That works for a while until it doesn't, because internal demand can't forever replace external opportunity. As the rest of the world slows, the US loses customers, exports weaken, profits shrink, and innovation cools. And as imports become costlier due to tariffs and supply reconfiguration, domestic prices rise, making everyday life more expensive. The economy begins to feel like a treadmill, a lot of motion, but little progress. In a way, the slowdown in trade growth reveals how deeply global systems are connected to local well-being. The cost of your groceries, the stability of your job, even the price of your next smartphone, all depend on how goods move across oceans. When those movements stall, the ripple touches everything. But there's another side to this story, the attempt to rebuild trade resilience. The US isn't simply retreating, it's reorganizing. Through policies like the CHIPS Act and Inflation Reduction Act, Washington is pouring hundreds of billions into domestic production. New semiconductor plants are rising in Arizona, battery factories in Georgia, and green energy hubs across the Midwest. These are designed to shorten supply chains, create high-tech jobs, and reduce dependency on foreign inputs. It's an ambitious strategy, and it's starting to work. Investment in U.S. manufacturing construction has doubled since 2022. But there's a catch. These projects are expensive, slow, and often automated. They create advanced jobs for engineers and technicians, but not nearly enough for the vast workforce once sustained by mass manufacturing and trade logistics. The future of trade is smaller, smarter, and more selective, but also less inclusive. For countries like Mexico, Vietnam, and India, the story looks brighter. They are the new nodes of a rebalanced global system, capturing industries once dominated by China. U.S. imports from Mexico have surged, crossing $475 billion in 2024, while imports from China have fallen below that level for the first time in 2 decades. This regionalization, or nearshoring, is reshaping North American trade. Yet even that momentum can't fully offset a broader global stagnation. The challenge for the U.S. is philosophical as much as economic. The entire post-war model of growth was built on the belief that open markets spread prosperity. Now the logic has flipped. Security, independence, and resilience have become the new virtues. It's a necessary adjustment in a fragile world, but it also means the age of abundance, cheap goods, rapid expansion, unlimited choice, is fading. You can already see the psychological shift. 10 years ago, Americans rarely thought about where their products came from. Today, everything feels political, from the phone in your pocket to the car you drive.
A trade slowdown isn't just an economic event, it's a cultural one. It changes how people see the world, less as a single shared system and more as a competition between guarded camps. That mindset will shape the next generation of policy. Expect more industrial subsidies, more Buy American campaigns, and more regional alliances like the Indo-Pacific Economic Framework. But here's the truth the data can't hide. Real prosperity still depends on exchange. Even in an era of self-reliance, no country can innovate in isolation. The flow of goods, ideas, and talent remains the oxygen of progress. If global trade is the bloodstream of the economy, the arteries are being rerouted, not cut off. The next decade will depend on how smoothly that rerouting happens. Too fast and cause spike. Too slow and stagnation deepens. Somewhere in between lies balance, a model where security and openness coexist. For workers and businesses, the adaptation will be uneven. Some industries will thrive under domestic investment, clean energy, defense, technology. Others, shipping, retail, and traditional manufacturing, may continue to shrink. But across every sector, one truth remains constant. When trade slows, jobs evolve. The future isn't about keeping the same roles alive, it's about transforming them to fit a slower, smarter world. Perhaps the hardest truth is that this shift isn't temporary, it's structural. The IMF calls it a lower speed equilibrium. The era of 5% global trade growth is over, replaced by a reality where 2% is considered healthy. For the US, that means adapting its ambitions, less chasing volume, more creating value. Competing not by exporting more, but by exporting better. Still, there's a quiet optimism hidden in the data. Slower trade growth doesn't have to mean decline. It can mean maturity, a phase where economies learn to sustain themselves without overextending. A world that trades less, but wastes less too. A world that values resilience over reckless expansion. The lesson for America is both simple and profound. Trade growth may have slowed to nearly zero, but the chance to redefine how the system works is wide open. Instead of chasing the old model of endless expansion, the U.S. can pioneer the next, one based on smart networks,
fair partnerships, and balanced interdependence. And maybe that's what this slowdown really is. Not an ending, but a recalibration. A reminder that even in a global system built on speed, sometimes slowing down is how you find direction again. Because in the quiet space between growth and stagnation lies a choice, whether to cling to what was or to build what comes next. Every slowdown hides an opportunity. The world isn't running out of trade, it's running out of old patterns. The US stands at a turning point, still powerful, still productive, but facing the limits of a system that once seemed endless. The path forward isn't about more or less trade, it's about better trade, cleaner, fairer, more resilient. Your job, your paycheck, your cost of living, all are tied to how the US chooses to adapt. Because trade isn't just about ships and tariffs.
It's about the unseen bridges between people, ideas, and work, and maybe that's the real story. In an age where borders are tightening, the world's next boom will belong to those who keep finding ways to connect.